You might have heard me talking about the stock market potentially looking very different in the coming 10 years than the good times that we've experienced in the last 10 years of investing. But what if I told you that there are 3 specific ETFs that may very well beat the market over the coming decade? This is no BS. Let me show you. So we're in one of the most expensive stock markets in history. Don't take my word for it, just look at the data. And I know I say this ad nauseum on this channel, but it's not to sit there and be a doom and gloomer. It's to sit there and say, be ready for underperformance for the next 10 years. And that's okay. The Buffett indicator, which Buffett considers to be the most reliable metric at any given time on stock market valuations, it compares the total stock market value to GDP, is at basically record highs we haven't seen since the Great Depression, before stocks fell 86%. The 10-year PE ratio, which takes the last 10 years of earnings, brings it to today, is still sitting 120% above the long-term trend. So what does that mean? Well, it's very simple. When you pay more for something, your return is less. Very simple. This phone's worth $1,000. If you pay $1,000 for it, you make $0. If you pay $100 for it, you make $900. Very simple. This is not something that's just made up. And historically, when stocks are this expensive, the next 10 years of returns are very weak. Not negative every year, but sideways for a long period of time. And when stocks are expensive, value investors like me, we go hunting for assets that are undervalued. That is exactly why in recent videos, I've been talking about energy, steel, and oil being purchased by some super investors like Warren Buffett. But today, I'm going to make a case for something most people have ignored, but is gaining traction. Something I've been invested in for quite some time. Gold. More specifically, gold ETFs and gold mining ETFs. And the 3 ETFs I'm going to share, I believe, could quietly beat the S&P and ETFs like SPY and VOO over the next decade based on history. I'm going to show you why I like them, what I own, and how to think about this the right way as a long-term investor. Now, before we get into the ETFs, let's zoom way out here. Gold has thousands of years of data. It's been a store of value across culture, government, empire. Kings hoarded it. Central banks still stockpile it, and even in times of chaos, wars, inflation, currency collapse, gold holds purchasing power when paper money doesn't. This is exactly why people call it a store of value. Now remember, gold does not give you cash flow, and I still believe that buying gold itself is a speculative play, but there is a way to invest in gold that's more about investing and not speculation. But gold has the history and the trust that a lot of people will look for during times of panic or during uncertain times. Now, this doesn't mean that gold's going to go straight up. It has booms and busts just like every other asset class. But over the long arc of history, gold has always served the same role. It's insurance against the failure of paper money. We left the gold standard in the early 70s. And since then, we've just had the devaluation of the dollar over and over. Now, I'm a value investor. Investors should all be value investors. All it is trying to buy $1 for less than $1, trying to get more than what you paid. And when popular assets, like stocks right now, look expensive, I look for what's being ignored. Right now, a lot of investors are bidding up the flashy stories. Meanwhile, gold miners are sitting at very reasonable valuations, even while their profits are improving as gold prices go up. So when price and value disconnect like that, you have to pay attention. It's an absolute must for any investor. Now, let me hit you with these numbers. So just bear with me, because if it sounds like a lot, it is going to make sense. So far, humans have mined about 244,000 metric tons of gold. And it's not exactly ton to ton, but a metric ton is about 1.1 tons. Now, there's also another 54,000 metric tons known to be underground that we've discovered. So there might be more somewhere else we don't know about. So that 244,000 metric tons is a total of 268,400 actual tons. A ton is 2,000 pounds. You multiply those two numbers together, you get 536 million pounds of gold. And to break that even further, there are 16 ounces in every pound. We have 8.6 billion ounces. Why do we talk about ounces? That's how gold is priced. And currently gold is at $3,450 per ounce. Now, keep in mind, just a few years ago, it's at $1,600. So it's on a little bit of a rip right here. That's a total of about $30 trillion worth of gold that's already been mined, and another $6.5 trillion sitting in the ground. Why does that matter? Because gold is actually finite. Unlike dollars or yen, or even crypto tokens, as much as they might want to say it, we can't just go print more gold. Supply grows very slowly, about 1 or 2% per year. That's it. Which brings us to our next point. Supply is limited. What about demand? Guys, it's rising fast. Go to any jewelry store in the world. What is the most expensive item in there? The gold items. That's what's really important to remember. And as the world gets wealthier and wealthier, as Africa gets wealthier, as India gets wealthier, as China gets wealthier, what are they going to want more of? Gold. Now, RBC, Royal Bank of Canada, projects that gold could climb close to $4,000 an ounce in the future. Guys, I have no idea if they're right or wrong. Frankly, I don't care. But if you're a believer that this printing of money is going to lead to inflation, if you're a believer that asset prices are very high, then you need to pay attention because close to $4,000 an ounce might not actually be it. And I'm not trying to project any numbers for the future. You guys know that I was buying gold miners years ago when gold was at $1,500, $1,600 an ounce because there was a major disconnect. And a lot of these gold mining companies today still sit at single-digit valuations and even low teens, which is very cheap compared to those tech stocks trading at 30, 50, and 100 times earnings. Now keep in mind, those tech stocks can really grow significantly just as well. But central banks have actually been buying gold at the fastest pace in 50 years. Why? Because they don't trust the fiat currencies long term. When debt levels rise and governments keep printing money, gold becomes the safety net. And as I'll show you soon, investors pile in, especially during times of inflation, uncertainty, and fear. It's not just government or hedge funds. Gold demand comes from the jewelry markets, especially India and China, where gold has cultural value and where they're getting wealthier. It has industrial usage like electronics, semiconductors, medical devices, and of course the investment demand we're talking about. Guys, this demand isn't going away. In fact, it's growing. And here's something that people haven't connected yet. AI, data centers, and the electrification boom mean higher energy demand. More energy leads to inflationary pressure, and inflation almost always boosts demand for gold. Now, I always hear this. Let's make the comparison. Bitcoin is the new gold. Guys, Bitcoin's 15 years old. We have a history of gold going back 5,000 plus years, and many could argue it was a store of value for that last 5,000 years. You can wear gold on your wrist. You can wire it into electronics. You can hand it down through generations. Try buying a Rolex made out of Bitcoin. You can't. Bitcoin may very well have a future, but I don't think it replaces gold's century of trust, demand, and tangible use. When governments and central banks hedge their risks, they don't buy Bitcoin, they buy gold. Guys, let me go to an extreme example here. Go to Africa, go to a tribe in Africa and show them gold. They're going to ooh and ah over it. Show them your Bitcoin and your phone. They're going to be like, well, that phone's pretty cool. Doesn't mean that Bitcoin can't grow from there. But gold has that love and desire everybody in the world values. It's shiny, it's pretty. Now let's look at history again. In the 1970s, while stocks went sideways thanks to inflation, gold soared from $35 to over $800 an ounce. In the 2000s, while that dot-com crash wiped out portfolios, gold climbed 600% over the coming decade. And during the crises like 2008, gold provided stabilities when equities tanked. Now, guys, let me show you these performance charts over some of these periods of time. So, guys, here's the S&P 500, 1990 to 2000, that huge market. The total return, 433%. This is gold in that time, down 25%. Stocks booming, gold's down. Let's look at the following 12 years, though, when stocks went nowhere. From 2000 to the end of 2012, the total return on the stock market, S&P 500, was 24%. And guys, remember, not to bring this up again, the stock market GDP here was actually better than what we have right now. That's what's scary. Let's look at gold prices in that same amount of time. This is gold during that whole entire period, 496%. 500% growth versus 24%. And guys, this is only the most recent example I use because I want people to feel like, hey, this isn't just 50, 60, 70, 100 years ago. This was in your lifetime. This is when a lot of our viewers were finishing high school and probably had families here. That is not a crazy amount of time ago. So when I say gold could very well beat the S&P over the next decade, it's not because I think gold is magic. It's because every time stocks are overvalued and inflation is sticky, gold shines, quite literally. Now let's take it back to today. Stocks are outrageously expensive. The Buffett indicator, the cyclically adjusted PE ratio, absolutely screaming overvaluation. Profit margins are under pressure. Gold miners, on the other hand, are trading at single-digit or low double-digit earnings multiples. They're throwing off record profits, but Wall Street ignores them because AI is a shiny object right now. Let's get back to the actual shiny object we need to focus on. Now, I've owned 2 of these ETFs for quite a while because I look at it saying, I don't think buying gold itself is a true investment. And here's why. My definition of investment, again, this is my definition, and I've taken this from many different places that made sense to me. If I took the market for this asset away, how would I get money? So I say the same thing about Bitcoin. If the market for Bitcoin went away, how would it generate me wealth over the next 10 years? It wouldn't. Gold, yeah, I could actually make the argument like, hey, listen, if the market for gold went away and I had a gold bar, I could still melt it down, make some jewelry. I could do stuff with it. But with gold miners, if the stock market went away tomorrow and I owned a gold miner, I would still see increased revenue, increased profit, increased cash flow. They'd pay me out dividends. And 10 years from now, if the market reopened and the company's making 5 times more money, my company investment probably has gone up at least 5 times. Now, the disconnect is overvalued stocks versus undervalued gold miners is exactly the kind of setup that value investors love. We're trying to connect it there because there's a massive disconnect. And like I said before, gold miners versus physical gold, I don't want to own the physical gold necessarily. It is speculative. It doesn't produce income. So for me, it's pure speculation. It relies on somebody else wanting it and paying more than I paid for it. But I look at the gold miners, and guys, what's interesting is this. We're sitting on one of the biggest profit margins for gold in history. Right now, it costs about roughly $1,400 per ounce for a gold miner to sit there and get an ounce of gold out. And at $3,450 per ounce right now, that's a $2,000 per ounce profit. These gold prices are strong, hitting record highs up nearly 20% just in the first quarter of this year. But the miners are trading at bargain levels. They haven't caught up yet. That mismatch creates a potential edge for people. So let's bring this home. Now, guys, I'm not saying get rid of the S&P 500. I'm not saying that at all. I still believe in dollar cost averaging, especially during bad times. As you saw with the S&P here from 2000 to 2012, if you had dollar cost average along the way, you'd probably bought at this level and you would see massive growth to today. So this is not a replacement. And again, don't buy anything just because I have it. You need to do your research on gold, and there's a lot of research out there. But ETF number 1, GDX. It holds the largest gold mining companies in the world, and we're talking about the big established businesses like Newmont and Barrick. I like it because it generates cash flow when gold is even moderately strong. And with the big margin we have between gold prices and gold mining costs, huge potential for these very, very efficient businesses. ETF number 2, GDXJ, the junior gold miners. Now, this one's going to be more volatile, but potentially higher upside if gold prices continue to run. GDXJ holds the smaller gold miners, the up-and-comers. They don't have the same balance sheets as the big guys, but if gold prices run, these juniors can explode. I personally own both of these. Again, never buy anything because anybody on the internet says it. I'm giving you my thesis here, and I would love for you to get engaged about it and open the idea of saying, wait a second, there are some valid points being made here. Maybe I should take a look. Now, for both of these, their expense ratio is about 0.5%, which is higher than most ETFs. So make sure you understand the potential down the road for this. Now, if you want to also own gold itself, GLD. It's the Spider Gold ETF. I do not own this one, but I mention it specifically for this reason. Some of you don't want to own mining companies. You don't want to think about balance sheets or dividends. You just want exposure to the gold price, pure and simple. Boom, there you go. That's what GLD gives you. It's one of the biggest ETFs in the world, and it tracks the spot price of gold almost perfectly. The expense ratio, a little bit cheaper, 0.4%. Now again, my personal preference is buying miners because they're businesses and that makes the most sense to me. But if your goal is simplicity, GLD could be the way to go for you. Now guys, if you're new to the channel, I want you to remember, I'm a very patient person. I can wait things out. I couldn't even tell you when I started buying GDX and GDXJ because of how long ago it's been, but I know it's been years. And I don't check my stocks daily, weekly, or even monthly. I like to sit there and wait things out. And I see a disconnect. I heard about a disconnect a few years ago on gold prices and the mining costs. And I thought, okay, there's potential here. And it just happened to have worked out so far. But I do believe that in the next 10 years, I can get some overperformance, some outperformance versus the S&P by owning some of these mining companies. That doesn't mean I'm going to be right. And if you don't have the ability to own these for 5 or 10 years, don't own them for 5 or 10 seconds, as Warren Buffett says. And again, I'm not telling you to replace your other ETFs. You still need to stay diversified, dollar cost average into your S&P funds. That's really, really important. Now, guys, there is a chart out there that I've seen that shows gold beating the S&P. It's a little misleading since 2000. The reason being, they're not including the dividends paid in the S&P. If you just look at price levels, gold has beaten the S&P from a price level standpoint. But if you include the dividends in the S&P, it has substantially beaten gold. With that said, who knows what happens if we see a big bear market for us? Now, guys, let's zoom out again for just a second because this isn't about hype. But gold could become hype. It's about principles. We are investors, not speculators. Every investment is the present value of all future cash flows. That's why I don't buy gold directly. I'm buying the companies. In the case of commodities, the value of scarce supply versus growing demand will drive up more price. Gold is undervalued relative to history. Stocks are overvalued. That's the opportunity. I don't know when that's going to flip on its head. All I know is that when it does, it is likely to be a very profitable opportunity for a lot of people. Guys, I believe in thinking about all investments, whether it's real estate, stocks, businesses, whatever it is, in a principle-driven approach. There are 5 tenets to it. If you're new to our channel or have been watching us for a while, I really encourage you to have the same foundational thought process. And this thought process of principle-driven investing will help you in so many facets of life related to money. So do yourself a favor. Download the PDF right now. It's absolutely free. Click the link below. It'll be in your email in less than a minute. And it's a great way to keep yourself focused on the long run and get your mind set the proper way for investing. So here's my takeaway. Stocks may very well disappoint over the next decade. That's what history's showing. History is also showing that gold miners, and gold ETFs could quietly outperform. You don't need to guess the next AI stock. You just need to pay attention to price versus value. And if you want to see exactly how I value ETFs in individual stocks step by step, click the video on your screen now. I'm going to walk you through my full principle-driven investing framework in our full investing course so you can make smarter decisions with confidence. And this is a video that's been gaining a lot of traction in the last few weeks. People are loving it. The next decade will belong to the investors who understand value versus price, while everyone is still licking their wounds when they chased the hype. Thank you for your time.